How do you protect yourself?
No, clearly, this year has been a roller coaster ride. So if you look from an economic recovery perspective, we are still in mid-cycle. So it's fair to be constructive about markets. But the escalation in trade wars completely come from blues. And I mean, nobody expected this to go beyond the pure rhetoric, the U.S. administration to come and impose tariffs. So markets taken 50 billion in stride. I think it's the 200 billion of tariffs imposition on Chinese exports, which is getting people worried. So let's see how it plays from here.
Exactly, but a roller coaster ride implies that you end up exactly the same place where you started. Okay, so will we by the end of the year, do you think?
See, again, valuations are cheap. When you talk to companies, it's not really impacted their business. It's really fear of what happens in 2019. Should these sanctions get imposed? Should people put the investments on hold? Should the wage hikes kind of slow down? So it's the fear of the unknown. But it may also happen that, look, should the US markets correct on this? Should they realize that imports of US goods are going up higher in terms of pricing, etc.? The sanctions, 200 billion, take a backseat. Markets may not be worried of all these things. They focus back on earnings.
That's the thing. And people looking at the US are going to look at China earnings as well coming up. What are they going to see? Because you look, as you said, valuations are pretty reasonable, aren't they, for Chinese equities? The point being that they're cheap for a reason. What is that reason? I
think let's look at these things. See, China always had structural issues, which was high debt to GDP, but over the last 2-3 years, it's been corrected. So corporate debt to GDP is fairly stable. What you're seeing is the slack being picked up by household credit. And again, there is a strong household demand, which is there in the economy. There's a strong consumption upgrade demand, which is happening in the economy. So that's the positive cycle. Outside China, India is growing well, so there are no issues on that. But look, if you have a situation which is massive trade wars all over the world, people are not focused on fundamentals, then poor active fund managers can't do much about it. But
yeah, that's the thing. And it's not the time to be a passive one, is it?
Clearly, again, the gap, if you look at some of these high-quality names, the staples, etc., and some of the not-so-poor quality names, is fairly high. So there is a money-making opportunity over there. The pessimism comes in the price. It's just that the worst fears don't have to come true.
But exactly, this is just it. So the point being, does the trade spat deepen in your view? Because this is going to be absolutely very important for the investment community.
See, we're still hopeful that this trade spat doesn't deepen. Again, the view is this is a lot of it is rhetoric going into the midterm elections in November. So as like the way I said before, as you see the negative impact of the $50 billion of tariffs which are imposed in terms of higher cost to the US consumer, as US economy takes kind of a bit of a slower growth trajectory, markets correct. I think the policymakers are a lot more pragmatic about imposing the next round of tariffs.